Welcome all to FSA Learning Module 7, EOCQs on the world of long-lived assets. Here we go. First up, based on this information, so we're looking at the information above, the amount of impairment loss that WLP will need to report on its income statement related to the manufacturing equipment is closest to. What do we have? An analyst is studying the impairment of the manufacturing equipment of WLP Core, UK-based corporation that reports under IFRS. So our IFRS impairment, one step, remember the US is two-step, one step in the IFRS world. We need the carrying value versus the recoverable amount. The recoverable amount, higher of, unusual for accountants, they're usually miserable and say lower of, but it's the higher of. You just need to show me what you can recover. The fair value less costs to sell, or the value in use. So fair value is 16.8. Costs to sell is 0.816. Value in use is 14.5. So that's not relevant. It's the higher of, it's 16. Recoverable amount is 16. Carrying value, what it's on the balance sheet at. Net carrying amount is 19.1. Recoverable is only 16. That looks like an impairment loss of 3.1, which is B. Next up, under IFRS, still IFRS, an impairment loss on a property, plant and equipment asset is measured as the excess of the carrying amount over the assets. We just did that, recoverable amount. It is B. And a third one here just to start off, the impairment of intangible assets with finite lives. Effects. Well, if we've got an impairment of an intangible with a finite life, it's not that much different to a tangible, to be honest. We'll take the asset and we'll reduce its value. And we'll take an impairment charge and hit the income statement. So net income will also come down. So only the balance sheet is not true. That ignores the impairment charge. Only the income statement can't be true because it hits the asset. It is clearly, hopefully clearly, both. Little scenario here. Melanie Hart, CFA, Transportation Analyst. Hart has been asked to write a research report on Altai Mountain Rail Company. Like other companies in the railroad industry, AMRC's operations are capital intensive, significant investments in long-lived tangible assets, such as property, plant and equipment. That's good for us in this section. In November of 2021, AMRC's board of directors hired a new team to manage the company. In reviewing the company's 2022 annual report, Hart is concerned, she's got concerns, about some of the accounting choices that the new management has made. Oh dear. These choices differ from those of the previous management and from common industry practice, not good. Hart has highlighted the following statements from the company's annual report. So we have three statements. Our question here is just about statement 1, so I'm not sure any of that was really necessary, to be honest. With respect to statement 1, which of the following is most likely, or the most likely effect of management's decision to expense rather than capitalize? Let's have a look. In 2022, AMRC spent significant amounts on track replacement and similar improvements. AMRC expensed rather than capitalized. So for everything we've read and all of that chat and all the concerns, it comes down to the classic capitalizing versus expensing. Our decision is to expense instead of capitalize. In what year? In 2022. So we're talking the current year. 2022 net profit margin is higher than if the expenditures have been capitalized? No, because if we expense, the whole amount hits net income this year. If we capitalize, only depreciation. B, 2022 total asset turnover is lower. Total asset turnover, that's revenue, divided by assets. We are not touching revenue here, we're just looking at assets for the accounting choice. If we, what did we do? Expensed, so if we expense rather than capitalize, our assets will be lower. We are not reducing assets by expensing. What we're saying, they'd be lower than if I'd capitalized. So total asset turnover lower? No. Because asset base has gone down in the denominator, that means this ratio will go up. It's not B. Let's hope for C. Future profit growth will be higher than if the expenditures had been capitalized. Well, in future years, if I expensed, nothing. But if I capitalized, in future years, we're charging depreciation. You're spreading the cost over future years, hurting future profits. You're not doing that. You rip the Band-Aid off in one go when you expense. It all hits this year. Answer is C. With respect to statement 2, so Melanie expresses concerns here, but we just need to focus on statement 2. What would be the most likely effect in 2023 if AMRC were to switch to an accelerated depreciation for both financial and tax reporting? What are we talking about? AMRC uses straight line at the moment of depreciation for both financial and tax to account for plant and equipment. So we're going from straight line to accelerated. What's that going to do? Well, you would assume if we have new assets, what that's going to do is increase depreciation expense in the early years. Later on, it will run out, but in the early years, it will increase. So most likely effect in 2023. So it's this next year. So it is the early years. Net profit margin would increase. No, because we've got more expense. Total asset turnover would decrease. Revenue over assets. You're increasing your depreciation expense. That's going to decrease assets. If you're decreasing the denominator, you're increasing that ratio, so not B. C, cash flow from operating activities would increase. Well, be careful here. Depreciation is non-cash. So it's got no impact on total cash flow. So you might look at that and think, oh, what? But we're talking specifically here, CFO. We are charging more depreciation expense in the early years for both accounting and tax purposes. So more expense means lower tax. More tax relief, lower taxable profits, lower tax. Lower tax is going to increase CFO. Quite a good question, that. Answer is C. With respect to statement 3, Melanie has concerns. They are chatted about, if that's a term, here in statement 3. What is the most likely effect of the impairment loss? Let's take a look. In 2022, AMRC recognised an impairment loss of €50 million on a fleet of locomotives. The impairment loss was reported as other income in the income statement. So it's in the income statement in that section, just kind of languishing around with other stuff, and reduced the carrying amount of the assets on the balance sheet, obviously. It's an impairment. So assets will come down by 50 and net income will come down by 50. What are we asked for? Effect. Net income in the years prior to 2022 was likely understated. Well, this is quite good because it's asking us to analyze the implications of an impairment loss, not just the accounting transaction. If it's impaired, that means previously our asset was, I'll put it in quotes, overvalued. I'm not saying we try and put fair value on the balance sheet, but we had it at a carrying value that was too high compared to what we can recover for it. And if it was too high, that suggests we hadn't charged enough depreciation. If we hadn't charged enough depreciation, profits in the past were too high. So they weren't understated, so I'm not going for A. Net profit margins in the years after 2022, so looking forward, are likely to exceed the 2022 net profit margin. Well, yes, in 2022, we are getting hammered with this big impairment charge. In future years, you will not have that impairment charge. Therefore, you would expect margins to pop back up. C, cash flow from operating activities in 2022 was likely lower due to impairment loss. No, impairments, not cash flows. It's not like your impairment loss is likely to be tax deductible here, so no tax implications. Answer is B. Couple of exhibits here to answer a question around a big case. We've got Exhibit 1, an income statement, and Exhibit 2, a balance sheet. And we're asked down here, based on Exhibit 1, the best estimate of the average remaining useful life of the company's plant and equipment at the end of 2022, so using 2022 figures, is. We need the average remaining useful life. Well, I'd quite like to use Exhibit 2 as well, if I may. Exhibit 1's helpful, but I'll need Exhibit 2 to get the average remaining useful life of the company's plant and equipment. What I'm going to need is the net carrying value, which is going to come from Exhibit 2 of plant and equipment. What have I got for plant and equipment? So land, I don't want to include land. I want plant and equipment, 6,000. Total property equipment is 6,700, including land. Accumulated depreciation is 1,850. I'm going to deduct all of that to get to the net value of property and equipment because land is not depreciated. So the net is 4,150. Now, average remaining life. How long is it going to take to depreciate that down to zero? Well, we can find that out by looking at what we're charging every year as depreciation. There's Exhibit 1, it's 200. 4,150 over 200 gives us 20.75. Remaining life looks like 20.75 years. Next up, question based around a whole world of chat between Brian and Jordan. So what are we asked here? Jordan's response about the financial statement impact of Alpha's decision to capitalize the cost of its new computer system is correct with respect to net income, total assets, and CFO. Let's have a look. Yeah, Brian Jordan is interviewing for a junior equity analyst position at Orion Investments. So just a bit of intro chat in here. Here we go. Jordan is told that, I think this is going to be relevant, at the beginning of the fiscal year, both companies purchased a major new computer system and began building new manufacturing plants for their use. Alpha capitalized, Beta expensed the cost of the computer system. Alpha capitalized and Beta expensed the interest costs associated with the construction of the manufacturing plants. We're interested just for now in the computer system. Ben asked Jordan, what's the impact of these decisions? This is the response we're interested in. Jordan responds, Alpha's decision to capitalize the cost of its new computer system instead of expensing results in lower net income, lower total assets, and higher cash flow from operating activities in the current fiscal year. Okay, capitalizing rather than expensing, and we're talking the current year. Jordan is saying it will lead to lower net income. If we capitalize, we only charge depreciation. If we expense, we charge the whole cost. Not a good start from Jordan. Because we're charging the whole cost in the current fiscal year, capitalizing only depreciation, capitalizing will actually give you higher net income. B, lower total assets. If we capitalize, the very definition of capitalizing means putting a balance sheet, or rather putting an asset on the balance sheet. You do not do that with expensing. No, Jordan. Higher cash flow from operating activities. If we expense, we would classify that as an outflow in CFO. If we capitalize, we would classify that as an outflow in CFI. So you're putting an outflow into CFI instead of an outflow into CFO. It would indeed lead to higher cash flow from operations. Redemption to a degree for Jordan. Question on Jordan's responses to a lot of chat up here. What we've got is alpha capitalizing and beta expensing interest costs associated with the construction of manufacturing plants. Jordan has been asked about the impact for that. Well, what does he say? Alpha's decision to capitalize its interest costs instead of expensing them results in lower fixed asset turnover ratio, higher interest coverage ratio. What do we think? Let's start with the fixed asset turnover ratio. In B, fixed asset turnover ratio is revenue divided by our fixed assets. What are they doing? They are capitalizing interest costs. If they capitalize rather than expense, that will increase my asset base. No impact on revenue. Because the denominator is bigger, that ratio will fall. What did Jordan have to say? Lower fixed asset turnover ratio? Yes. He's correct about that fixed asset turnover ratio. It would fall. But what about the interest coverage ratio? A higher interest coverage ratio? You might be thinking if we capitalize, interest expense would fall. However, your interest coverage ratio should be based on what was paid, not what was charged as interest expense. You will see in places in this curriculum calculations where interest expense is used because that's all you're given, but you should be using paid. If you use paid, then you're not impacting that interest coverage ratio. So it is just B. Jordan's response about the impact of the different depreciation methods on net profit margin is most likely incorrect. We're looking for incorrectness here. And this is where we're relevant. Jordan is told that alpha uses straight line depreciation. Beta uses accelerated. Both companies estimate the same useful lives. So it's just the straight line versus accelerated. Many companies in their industry use units of production. Ben asks Jordan, what are the financial statement implications of each depreciation method? And how do you determine a company's need to reinvest in its productive capacity? What does Jordan reply? All other things being equal, straight line depreciation method results in the least variability of net profit margin over time. Well, I can go for that. Straight line is the same expense every year. Given it's the same expense every year, it does indeed give the least variability. Accelerated comes in hot and then tails off, and units of production depends on your production pattern, could be all over the place. So I think he is correct about straight line depreciation, so it's not that. Accelerated depreciation method results in a declining trend in net margin over time. Oh no. Accelerated gives you declining depreciation. If you've got declining depreciation, that means all else equal, your margin would be rising. So I think he is wrong about accelerated depreciation. The units of production can result in net profit margins that are quite variable, yet, because it's all dependent on your units of production that occur. So definitely A, that was incorrect. Jordan's responses. What are we looking at here? Jordan's response about his approach to estimating a company's need to reinvest in its productive capacity. It's going to be up here. How does he calculate that? I use a 3-step approach to estimate a company's need to reinvest in its productive capacity. First, I estimate the average age of the assets. All right, seems sensible. Average age. By dividing net PPE. So we'll take net PPE from the balance sheet by annual depreciation expense. Net PPE by annual. Well, that tells you what the carrying value is. So let's say, for example, just making numbers up, net PPE was 100 and depreciation expense was 10. That would tell you it's got 10 years remaining. It's going to take 10 years to depreciate what's left. That's not the average age. That is the remaining life. So he's not right about the average age. Secondly, I estimate the average remaining life. Well, this should be interesting because he's used that to get the average age. What does he do for the remaining life? By dividing accumulated depreciation by depreciation expense. So let's say accumulated depreciation on the balance sheet is 50 and depreciation expense is 10. That tells you they're 5 years old. We've so far charged 5 lots of 10. That is the average age. He has quite simply got them the wrong way around. So the remaining life, no, also wrong. Total useful life, third. I add the estimates of the average remaining life and the average age in order to determine the total useful life. Well, he's adding two things together that are wrong, but because they were simply the wrong way around, you'll add 10 and 5 instead of 5 and 10, and that will actually, due to compensating errors, be correct. So it is B. Jordan's response about the effect of beta's impairment loss is incorrect with respect to its impact on its. So we have an impairment loss. Let's have a look. We are told over here, beta recorded an impairment loss on a manufacturing plant, and Jordan responds, beta's impairment loss increases its debt to total assets and fixed asset turnover ratios and lowers its cash flow from operating activities. Straight away, I'm going for C. An impairment is a non-cash charge. It does not affect CFO, will have no tax impact. Tax authorities aren't interested. So it has to be C. Is he correct about the others? Debt to total assets. Debt over total assets. We have an impairment. Assets are coming down. Debt is not being touched. If the denominator is falling, that is increasing. Kaboom. And fixed asset turnover ratios, revenue divided by assets. Same argument. The numerator is not being touched. The asset base is falling. It will also rise. Increase that and that. Yes. So they were both correct. So C is the right answer. Jordan's response about the effect of alpha's revaluation is most likely correct with respect to. So we have over here alpha revaluing a manufacturing plant, increasing its reported carrying value by 15%, no previous downward revaluation of the plant. What does that mean? Let's say carrying value was 100. It's now gone up to 115. So assets on the balance sheet clearly rise by 15. That's meant to be an arrow. Where does that gain go? It goes directly to equity. It does not flow through net income. You will get a revaluation reserve as part of equity of 15, but you won't touch net income. So what's Jordan got to say about this revaluation? It's these last two lines. Alpha's revaluation increases its debt to capital and return on assets ratios. So debt to capital, we've got debt over some measure of debt and equity. We are not touching debt. We are increasing equity. The denominator has increased. The numerator stays where it is. That ratio will fall. It does not increase its debt to capital. Return on assets, net income over assets. Assets will rise. Net income is not touched. The gain does not go to net income. It goes directly to equity. Numerator untouched. Denominator, the asset base rises. That will fall. Increases return on assets? No. Return on equity, net income untouched. Equity will rise because we are taking the gain to equity. No change to the numerator. Denominator rises, that will fall. Reduce its return on equity. Yes. Part of the reason companies are not keen on revaluing. A financial analyst at V02 SA is analysing the result of the sale of a vehicle for 85,000 Argentine pesos, so proceeds are 85,000. On 31st of December 2021, the analyst compiles the following information about the vehicle: acquisition cost, acquisition date, and so on. What are we asked? The result of the sale of the vehicle. We need to calculate the gain or loss. So acquisition cost, acquisition date, residual value, expected life depreciation. We need all of this to calculate its carrying value. The gain or loss will compare the carrying value and the proceeds. Historic cost was 100,000. Accumulated depreciation. What have we got? Estimated residual value is 10,000, so the depreciable amount is the cost minus that residual value, 90,000. Expected life is 9 years straight line. That's pretty easy. We're charging depreciation expense of 10,000 per year. Now, when do we get it? 1st of Jan 2019. When are we selling it? Sale of a vehicle on 31st of December 2021. So 1 Jan 19, go to 31st of December 19, 31st of December 20, 31st of December 21, 1, 2, 3 years, 30,000. In total, accumulated depreciation is 30,000. Carrying value is 70. What do we sell it for? 85. 85. It was only on the balance sheet at 70. That is a gain of 15. We have replaced an asset with a carrying value of 70 with cash of 85. That's got to be good news. Croco SPA sells an intangible asset with a historical acquisition cost of 12 million and an accumulated amortization of 2. Carrying value is 10 million. And reports a loss on the sale of 3.2. Disappointing. Which of the following amounts is most likely the sale price? What were the proceeds? Well, we know if you take your proceeds less the carrying value, that gives you your gain or loss. On this occasion, a loss of 3.2. The carrying value was 10. We lost 3.2 and the carrying value was 10. Proceeds were only 6.8. If we made a loss, you know the proceeds must be lower than the carrying value. On this occasion by 3.2. Answer is A. The gain or loss on the sale of a long-lived asset to which the revaluation model has been applied, so in the world of IFRS, is most likely calculated using sales proceeds less. Well, I don't really care that it's been revalued. When you calculate the gain or loss on sale, you take your proceeds, you deduct the carrying value, you have your gain or loss. It is as simple as that. So A, carrying amount, yes. B, carrying amount adjusted for impairment. I mean, if it's been impaired in the past, I guess, but if it has, it would be reflected in the carrying amount on the balance sheet. Historic cost net of accumulated depreciation. That would normally be the carrying amount, but we've revalued, so that wouldn't work. So it is A. Bit of an odd one, that. According to IFRS, all of the following pieces of information about property, plant, and equipment must be disclosed. What do we disclose under IFRS? In a company's financial statements, except for, or what does not get disclosed? Useful lives, acquisition dates, yeah. Useful lives, definitely. Acquisition dates, no. Amount of disposals, they will be. Imagine having to disclose the acquisition date of every asset you've got. That would be crazy. According to IFRS, all of the following pieces of information about intangible assets must be disclosed in a company's financial statements and footnotes, except for, which does not need disclosing about intangibles: fair value, impairment, loss, amortization rate, Definitely needed to know the rate of amortization. That's your policy, really. Impairments are always disclosed. There is no requirement to disclose the fair value of all of your intangibles. Which of the following is a required financial statement disclosure for long-lived intangible assets under US GAAP? What do we need? The useful lives of assets, the reversal of impairment losses. Well, that's an easy one because under US GAAP, the reversal of impairment losses is not necessary. C, estimated amortization expense for the next 5 fiscal years. Yep, that is required as a disclosure for intangible assets. IFRS would need the useful lives, but US GAAP not specifically. Which of the 3 assets is an intangible asset with a finite life? Patent, goodwill, or copyright? Copyrights can go on forever. Goodwill has no finite life, and under IFRS is actually categorized separately from intangible assets. So best answer there, I think, is a patent, assuming the patent has an expiry date. Intangible assets with finite useful lives mostly differ from intangible assets with infinite useful lives with respect to the accounting treatment of. Well, the big difference is if it's got a finite useful life, you amortize it. If it has an infinite life, you do not. It differs in terms of amortization. Costs incurred for intangible assets are generally expensed when they are internally developed. It's all about reliable measurement. That's where that rule comes from. It's not random. The point is, if it's internally developed, it's very difficult to try and establish exactly what we spent on it. If you acquire it, you know what you paid for it. If you acquired it in a business combination, then you can allocate your payment to each of the assets, so it's easier to measure. Answer is A. And it's worth pointing out, generally expensed here, there are exceptions. You might be screaming about development under IFRS and software. Well, yep, they're exceptions, not the general rule. Under US GAAP, when assets are acquired in a business combination, goodwill most likely arises from. We calculate goodwill by comparing the purchase price to the fair value of identifiable net assets. So contractual or legal rights will be part of the fair value of identifiable net assets. Assets that can be separated from the acquired company, same thing, will be in here. Assets that are neither tangible nor identifiable, intangible assets. That is the answer. These two are both part of this. So if you paid, let's say that was $3,000, this is $2,000. Both of these are included within that $2,000. The difference are these mythical assets here.